In this week's tutorial, we're going to look at another question on IAS 7 statement of cash flows. But the reason I chose this one this week is it's a past exam question, but it's slightly shorter than the other one and it's laid out slightly differently in that you're given the statement of financial position for plush for both years, but you're actually not given a statement of profit or loss. So there's a different setup to this question. That's why I want to get you away from just saying the statement of cash flow questions are all the exact same. They can be set up slightly differently. And I know a lot of students might have struggled to even start this question because you might have struggled to find a profit figure to start with. So it says you're asked for here is to prepare a statement of cash flows for Plush for the year ended 31st December 2016, accordance with IAS 7. Note, although you're only given an extract from the statement of financial position, it's not a full one, the question says anything that's not given won't impact the statement of cash flows. So it should balance overall. So essentially, you can see that as a full statement of financial position. And then you're given notes about depreciation, cash and cash equivalents, inventories, expenses that are in the P&L as well, and the dividends in note 7. So that's all well and good. The first thing we're going to look at is, well, what's the answer? What's the final answer we're looking for in the move in the cash and cash equivalents from 2015 to 2016? So we're told cash and cash equivalents, we're given it in the question, is 50 and 67. Right? No issue with that. They're given directly in the question. But you're also told in note 2 here that the cash and cash equivalents include a long-term investment in shares of 1 million. In 2015, there were 1 million as well, and they're held appropriately at cost. So you have this share investment, shares of 1 and 1. We need to take that off. And essentially what that's examining you, it doesn't change the answer overall, in that it's still a decrease or overall minus 17. Still a decrease in cash and cash equivalents over the year of 17. But the key point is it's not correct to include long-term shares under IAS 7. So the minus 17 is correct. Not under definition of IAS 7 for cash and cash equivalents. So that the long-term shares, they're not going to meet that criteria of less than 3 months maturity. It doesn't impact the cash flow overall. Still going to have the same answer, but to get a mark, because to show your understanding of what cash and cash equivalents is, you would have to take that out there. So that's your opening balance in cash and cash equivalents and your closing balance. And once you have that answer complete, you're then going to set up a template. And I would always advise students, and I'll just have it set up here, you have a statement of cash flows for the year end, whatever it is, operating activities, investing, and financing. And you leave a couple of lines between each, depending on how many items you need. Then you come down here to the bottom. We know the opening balance, we said, if we go back to the workings here, opening was 66, closing 47. And this is minus 17. And this is all coming from working 1. So you can show the examiner, I know how to figure out the final answer. And remember, there are marks going for this. This is a key disclosure requirement under IAS 7. So you must show that what the opening cash and cash equivalents were and what the closing ones were as well. So hopefully what we're trying to figure out now is when we do our operating activities plus our investing activities plus our financing activities, it should come to negative 17,000. So this should be millions. So I'll just put there millions to be consistent. Right, but that's a key thing we need to make sure we're happy with is how you start the question. Start it with the net movement, which will be given as the answer in the question, and then we'll start the template. Have it set up and you slot them in as you go along. Now, usually your next starting point then is cash flow from operations. Cash flow from operations. And we would usually use the indirect method. Now, you can use the direct method if you want, but the indirect method is often the quicker and easier way to start. And also, I won't dictate which one you have to do in an exam. I will give you the choice. But I'd usually start with the indirect method. The problem is here, I think a lot of students might have copped on, you have no profit for the year, profit after tax. We don't actually know what it is. So we don't know what the profit after tax is because we're not given a P&L. We are told what depreciation is. We are told, for example, of inventory write-off. We are told about finance costs and tax expenses. But nowhere are we actually given the profit for the year. And that's why I've included this particular question here, because it's just a different way of starting it. And some students may have struggled with this in an exam format. what you actually had to do is come down to working 3. I know what I'm looking for. I'm looking for profit for the year, but I don't have it. But I know there's a relationship between other line items and profit. And for example, if I do my retained earnings T account, retained earnings, I know I can solve for my profits. Sometimes I'm solving for dividends, but in this case, you're going to be solving for profits because they tell you what the dividend is already. So it's a slightly different way of going about it. Your balance brought down, opening retained earnings was 32 million, given in the question. Your balance carried down at the end was 45, and they tell you in note 7, see the way they say in note 7 there, retained earnings, dividends paid out, so you'll say dividends here, which would be debit retained earnings, 4 million. Now that in itself, if you want to highlight it, that is a statement of cash flow item. That's going to be a financing cash flow, which is going to be payment of dividends. We'll come back to that in a second. As your whole dividends paid out of 3 million. It should be 3, note 7. And that must mean then, well, this side is totting to 48, and we'll put that as a total. The other side must have tot to 48 as well. So we're saying, how can we go from retained earnings of 32, paying a dividend out of 3, and still get retained earnings of, just try and clear up this, of 45. And that must mean this has to be 48 as well. So your SOPL, your profit for the year, must be 16. Right, so that's important that we understand how we got to that. That was a tricky one. Usually you're given a profit figure directly. In this case, we had to work back. We're given dividends, we're given an opening retained earnings, we're given a closing retained earnings. We can solve for the profit for the year. So we then go up and say profit after tax 16 and show the examiner it's coming from working 3. Right? And if you're a good student and you want to save time, I would actually go back into my template now, net cash flow from financing activities, dividends paid, and I'll just say there, note 7 minus 3 million. You put your dividends paid. So you're slotting them in as you go along. You don't have to, you can wait till the end if you want, but it's easier. As you remember it, and by having a template set up, it just makes things a lot quicker and a lot more efficient. So think about that, the benefit of having a template set up, you can slot in things as they come to you. So that's our first protocol, is our profit after tax. We're going to add back our tax expense, and we're going to add back our finance cost expense. Because again, these are given in note 6 and note 5. These are expenses. They're in the P&L, they're not necessarily how much you've actually paid. We deal with that in the face of statement of cash flows. So you add back here the tax expense, which is 4, and you add back the finance cost, which is otherwise known as the interest expense, that is 6. Just adding those back because you said they are not necessarily the actual cash flows, they're just expenses. They're an accounting adjustment. The other adjustment we add back is depreciation, and that's given in note 1. There's 5 million in depreciation. So I remember depreciation is a non-cash expense. You add it back. So it would be beneficial for you to have a template done of the indirect method and all the different types of ones that can come up. Another one that you'll often see here is related to profit or loss on disposal. So during the year, Plush disposed of equipment for 4 million that had a carrying value of 3 million. Sometimes they tell you what the profit or loss disposal is. And here they tell you they disposed of it for 4 million. That's the cash inflow. Right, so that's important. That's the cash inflow. Sold it for 4 million. Had a carrying value of 3 million. So that means you had a profit on disposal coming from note 1 of, in this case, 1 million. And it's a -1 because the profit on disposal is a non-cash income. If you want to think about that again, think about the debits and credits here. You will credit the net book value of equipment. You're going to credit that 3 million. you're going to debit bank 4 million, and you're going to credit the SOPL 1 million. That's what the debits and credits would have been. So if you can think of it on that basis, it makes it easier to understand the adjustments. This is a statement of cash flow item. That is going to go in to your statement of cash flows as disposal of equipment. You made here credit net book value. We're going to use that when we explain the movement in property, plant and equipment later on. And this is a non-cash adjustment because it's a non-cash item in your profit figure. So included in this 16 million is 1 million that's actually an accounting adjustment. So there's a lot of repetition in these if you practice them. So I'm going to put in investing activity, disposal of equipment. I'm going to say note 1, and I'm going to put in positive 4 million. That's coming from the disposal of equipment there. So particularly when you have a profit or loss in disposal, there's a lot of moving parts that you need to watch for. Also in that note 1, we're told there's a revaluation increase in property during the year of 10 million. Revaluation surplus gone from 20 to 30. We will use that to explain this increase at the end. For now, we can park that. It's not going to impact our indirect method here. So we go down along and see is there any other items. We've dealt with note 2. Note 3 tells us during 2016, the company had to write down the carrying amount of inventories by $500,000 due to inventory obsolescence. So this is an inventory write-down. That's a non-cash. So that would have been an expense, the inventory write-down, but it's actually not related to cash. So inventory write-down, note 3, you add back $500,000. The reason being that would have been an expense in calculating the 16 million, but actually it's non-cash because all you're doing is debiting the expenses, crediting inventory. So from our perspective, we add it back when we're trying to get the cash flow for the year. That was a tricky one, an exam one. It's linking back to your knowledge of IAS 2. It's a non-cash expense. That's why we add it back, same as depreciation. So when we start looking then, we've got our non-cash adjustments. The next thing is our working capital. Working capital adjustments, we deal with inventory. We deal with trade receivables and trade payables. So again, there's a lot of repetition here that you have to make sure you're happy with how to use the indirect method. So let's go up then. We're going to deal with trade receivables and trade payables first because inventory is a bit trickier with that write-down. We'll come back to that. So for trade receivables, it's 2 versus 1, which is an increase of 1. So that is going to be minus 1. Right, an increase in trade receivables, it's just 2 million versus 1 million. And that's fine to show the examiner that's what you're looking at, 2 versus 1. An increase in trade receivables year on year is a drain in cash flow. For trade payables, it's a decrease. It's 3 versus 4. 3 versus 4. A decrease in trade payables is a drain in cash flow as well, minus 1. All right, so watch for that in the questions. Increase in trade receivables is bad. Decrease in trade payables is bad. They're the opposite in terms of cash flows. But showing it like that is fine from the examiner's perspective because it's a quite straightforward calculation. The inventory is the trickier one here. We want to know what's the true movement in inventory year on year. And what a lot of students do there is they'll say, 10 versus 5. It's actually 10.5 versus 5. The key point being the true value of inventory is 10.5. You just happen to write off $500,000 because it's a write down. But in terms of actually purchasing inventory, the cost of it in a cash flow perspective will be 10.5 million. So that's minus 5.5. Now that's one that's really an exam level trick that catches students out there. Is because that inventory was actually bought, it still was paid for. So technically it's 10.5. You're reversing that write down because it's non-cash. So you're comparing like for like then. You want to know how much you spent in inventory versus what was there last year. So it's 10.5 versus 5. That is a very tricky one and quite a tricky one. A lot of students didn't get it that year when it came up in the exam. But that was you won't get too many of those, but it's important to see you're reversing the write down, but that means you're also bringing it back into inventory as well. So your inventory was actually 10.5 before the write down. And we use that figure to calculate the movement. Similarly, if there was a movement or an increase in bad debts, or for example, bad debt provision, you do a similar logic with trade receivables. And you might see them in a couple of past exam questions that come up later on in the semester as well. So taking those working capital movements, we're going to get cash from operations before we take off interest and tax of 23 million. So these all, remember, are in millions to match the notation that the question provides. And we take that 23 million, working 2, and we slot it in. 23, and you can say to the examiner, working 2. So it's nice and neat. You're using your template and you're getting your marks for presentation as well. Next one we're looking then is interest and tax paid. Now, if there was no current liabilities for interest and tax, we wouldn't have to deal with any adjustment. We just take the P&L figure. But both interest and tax have adjustments. So we're going to do working 4 and working 5 for interest and tax paid. I'm going to open up a T account. Now, some people say they don't need a T account, and that's fine. You can skip it as long as you get the right answer, but I'll use a T account just to show the basics. So we're going to look at taxation. So I think interest is first, and then we look at taxation for note 5. So it's nice and neatly labeled, showing the examiner where it's coming from. So let's delete all of these and tidy it up. So we have our balance brought down for interest payable. Interest payable at the start of the year was 7. Balance carried down at the end of the year, so which is your balance brought down for next year, is 5. And we know debit, the P&L, credit interest payable, the SOPL, had a charge for finance costs of 6 million. So that's your starting point, is laid out like that. We owed 7 at the start of the year. We owe another 6 because of the current year. That means if we paid nothing, we should have owed 13. We actually only owe 5 at the year end. So that means we must have paid 8. Credit bank, debit interest payable. And that is the amount that you're going to put in to your statement of cash flows. Working for interest paid minus 8 million. So you're using the information that you have, right? You're solving a puzzle as you go down along. That's why I say always see it as solving a puzzle. We're doing the same for taxation. Again, pause this now if you want to practice yourself and see can you do it. Your balance brought down, you owed tax at the start of the year of 4. You owe tax at the end of the year, balance carried down of 3. And the only thing that moves it during the year is the expense, which is 4 million from note 6, or the amount that you paid to bank. Right, so it's the same question the whole time. If there's no opening or closing balance, then you just take the figure that's in the P&L. It's actually a bit easier. But in this question, we had opening and closing balances for both interest and tax. Okay, so what we're saying here is we owed 4 tax at the start of the year, and we incurred another 4 during the year. So at the end of the year, if we paid nothing, we should have owed 8. We actually only owe 3 based on the financial statements, and we assume these are correct. So we must have paid 5 to the revenue authorities during the year. So that would have been credit bank, cash outflow, debit, tax payable. And that's going to slot that in working 5. And now you have your cash flow from operating activities complete. So we go back, interest paid minus 8, tax paid minus 5. So your net cash flow from operating activities is 10 million. And that's a very similar format you'll do each time. The only tricky piece in this exam question was how to figure out the profit after tax. Because you're not given a P&L, you actually had to work back using retained earnings. Bit of a trickier one. So once you have cash flow from operating activities complete, I now go back and the next step is look at the statement of financial position and click off the ones that you've already explained or highlight them. So we've already explained those. Interest payable, trade payable, tax payable, done. Retained earnings, done. So we've all of those complete. So we're only left with 4 line items to figure out and see can we get this thing to balance. Because currently if we add them up, they're only at plus 11. So that doesn't make sense. It should be minus 17. But your last step is always explain the rest of them. So we're going to start off initially with explaining the movement in property, plant and equipment. Working 6. So working 6, we'll take this down. Because remember, you're going to be doing your exam in Excel and Word, so you can just copy and paste yourself as well. There's no problem at all. PP, be careful now, remember this is net book value. So we're looking at cost and accumulated depreciation together. Your balance brought down, opening balance was 20, and your closing balance carried down is 40. So we need to explain How did property, plant and equipment get from 20 to 40? The plug figure will be the acquisitions during the year. Now remember, there's a couple of things going on, and it won't always be like this. Sometimes they'll give you cost and accumulated depreciation separately. We know there was depreciation charge in the year. That will be 5 million. Debit depreciation expense, which we adjusted for in working 2, non-cash. Credit accumulated depreciation, which would also be a credit to the net book value when you merge them together. We know there was a disposal during the year. You will credit the net book value 3 million, as we've set up here. Credit the net book value 3 million, because you're getting rid of it. And the other thing we also had there was a revaluation, and that is a revaluation of 10 million. That explains that reval surplus going up. Now, some of you might say that's not really how we do a revaluation gain. Well, remember, we're looking at cost and accumulated depreciation together. So technically it is kind of similar. Instead of netting one against the other, we're just looking at the net increase. The net book value has gone up by 10 million and we're increasing the net book value here. We don't need to clear out accumulated depreciation first because we're looking at a single net book value line item. So we're not inconsistent there. It's just a different way of presenting it. If you got cost and accumulated depreciation, it'd be a slightly different approach. But usually we only get a revaluation increase when we look at net book value. So that means this side is 48. This side should be 48 as well. So we're missing the acquisition, or credit bank, debit property, plant and equipment, 18. That's the only way this will make sense. The only way it makes sense is if we acquired property, plant and equipment during the year for 18 million. That will explain how we got from 20 million opening balance to 40 million closing balance, accounting for depreciation, accounting for the disposal, and accounting for the revaluation. So particularly for property, plant and equipment, that's one of the ones you should really think about using a T account, because there's a lot of moving parts, and if you miss out on one, the whole thing is not going to balance. So let's bring that back to our statement of cash flows. Acquisition of equipment, or acquisition of PP. And we're going to say there working 6 minus 18. All right, so we're working our way down along. We've everything explained now bar the loan. And to be honest, the loan doesn't necessarily even need a T account here. You're split the loan between current and non-current. And you're told in note 4 that the company has one loan. It has been appropriately classified as current and non-current. So essentially, as the loan has been repaid, it's reclassified. So within the next, you've paid 10 million of it between 15 and 16, because it's gone from 90 million overall to now 80 million. You don't need to separate them out. They're essentially, the loan is still 80 million, albeit you're going to pay 10 million within the next 12 months. So what you can just put here is loan repayment. And all you put there is 80 versus 90. That is minus 10. What you've done is you have credited a bank, cash outflow, debited the loan. Even though it's split across current and non-current, that's not an issue. There's no problem with that. That's just a classification of when it's going to be repaid. But this year, it's gone from a total 90 plus 0, to a total of 80, 70 plus 10. So that is a repayment of 10 million, minus 10. Now, if we look at the solution, just to double check, we've finished all of these, we've explained each of them, and we come back. We have 10 million operating activities, minus 14 investing, which gets us to a negative net minus 4, and minus 13 from financing activities. So that means the net decrease is our 17 million that we've calculated before. So we actually know we're correct. We solved that puzzle and it works out. Cash and cash equivalents, the 1st of January, 66, and the end of December, 47. So that's not an overly long statement of cash flow question, but there is a couple of tricks involved. So it is important that you go back now, make sure you're happy with it, look at the way it's laid out slightly differently than the tutorial in week 3, and particularly note the trick around how to start it. You weren't given the profit after tax figure, but you had enough information there to figure it out based on retained earnings and the dividend in note 7.